Thursday, March 7th, 2024, Monaco 64, home of alternative economics and contrarian views. Today, we're going to look at the date that will live in infamy, and not the Pearl Harbor date, but the date that condemned the dollar to destruction, to worthlessness. Yes, it was the day that Bernanke announced QE, and that was on November 25th, 2008. And I'm going to reference some great research by the late Ron Rosen, who I used to love following. And yes, we're going to look at why gold really is breaking out. And yes, it will be a good thing for us who have been stacking gold and silver for that matter. But for the US dollar and for the general public, it won't. And that's why they don't tell you anything about gold. They don't want you to protect yourself. And talking about we're going to look at a couple of examples of jobs for the boys, so to speak. Don't want to use the C word, corrupt. But I think you'll be able to put two and two together and see what I mean. And so we'll look at that first. And it's to do, of course, with recent events. So we've been looking at the banking situation, of course. I spoke about the FDIC yesterday, the fact that they've delayed publishing the Q4 profile. Apparently now, though, they're going to come out with it today. It's not out yet. So today is March 7th. About almost 2 weeks late. What's going on, right? You need to ask that question. But anyway, yesterday, New York Community Bank Corp, which is one of the banks that have been in trouble for the last month or so, or probably even longer, but we didn't know about it until a month ago. It was down 42%. Yeah, I remember a week or two ago it was trading above $4, and now yesterday it was trading at a 1 handle, and all of a sudden there's a savior for New York Community Bank Corp, and his name is Steve Mnuchin, and many of you probably remember who he is. Well, he was the Secretary of the Treasury under Donald Trump. And his first year as Secretary was also the last year that Janet Yellen. And you can see Janet Yellen here with Steve Mnuchin. It was the last year that she was Secretary or chairman of the Federal Reserve, or chair, if you want to call it, or chairwoman, right? So I'm going to have a go at a little bit of a comedy. A bit of comedy, and it probably won't be too good, but let's try it. So yesterday, yeah, New York Community Bank, I think it's got $80 billion in deposits. Almost finished, right? And Secretary Mnuchin, yeah, these people like calling themselves secretary even though they're not secretary anymore, right? So he gets a call in his office and he goes, "Yes, hello, this is Secretary Mnuchin." "Oh, hello, Steve. This is Secretary Yellen. How are you?" "Oh, I'm great. And you?" "Oh, doing well. Trying to keep things together." "Steve, I wanted to talk to you about New York Bank Corp." And Steve replies, "You mean that that dog of a bank? I wouldn't even touch it with a barge pole, Janet." "Oh, really? Is that how you see it?" "Yes, that's how I see it." "Well, I've been speaking to the president. I've been speaking to the FDIC and the Fed, and I think it's a good bank, if you know what I mean." "Oh, I see, Janet. I see, Janet. Yeah, let me see what I can do about it. If I can drum up some support, and I'll give you a call back. Oh, Steve, I just wanted to let you know, if things work out, don't forget to have me over at New York Bancorp for one of my speeches after I retire here from the Treasury Department. That would be great. Oh, no problem, Janet. You'll be first on my list, and we can sort out the terms later, right? Oh, no problem, Steve. Take care. So there you go. Am I saying this is what happened? Of course not. Am I saying that Steve Mnuchin didn't think that it was a good investment to put some good money into some bad money to catch a falling knife? Maybe he thinks New York Bancorp is a good business, and that's why he drummed up support here. As you can see, Steve Mnuchin backs New York Community Bank in $1 billion deal. Mr. Mnuchin, the former Treasury Secretary, led investors who put together a package in an effort to rescue the struggling lender. And you have to wonder, of course, if there was any egging on from the U.S. Treasury. Well, we'll probably never know. Here in the UK, of course, we had our budget, and you'd be pleased to know that Jeremy Hunt has taken some of your tax money to lend to Canary Wharf, what's it called? Canary Wharf Group, $118 million. Pounds, excuse me. And how does that work? Well, you know, it is a loan, so he's not just giving them the money for nothing. But how could it work after, or if the Tories lose the election and he's still an MP, he wins his seat still, Jeremy Hunt, but he's not in government? Well, you know, he could get a post on the board of Canary Wharf Group and be paid a pretty good amount for showing up a few times a year. And that's how it works, the corruption, so to speak. He'll be taken on as a member of the non-executive board or as an advisor, right? That's what Tony Blair did. You know, when he went to work for JP Morgan, I'm not sure if he still works for them, on £2 million a year. Back to the the main topic here, and before we go on to the main topic of the date that will live in infamy for the US dollar, just wanted to let you know that if you're looking to keep your valuables safe, especially in this time of government largesse where they're coming after everything you own, not just financially, but you know, physically as well. You will never know when they'll come after your stuff. Think about the dirty man's safe. It's a great way to keep your gold and silver and other valuables safe. Have a look at the description below. You get a 10% discount if you use the promo code MANECO10. So back to the date that will live in infamy, and you can see here from this article, it's from Reuters, and it's from October 9th, 2013, timeline. Fed's Bernanke saw U.S. economy through turbulent times. And I think this is when Obama nominated Janet Yellen as Fed chairwoman or chairman. So she's still around, isn't she? But if you scroll down to the timeline of the crisis of '08, you come to the date November 25th, 2008, as you can see here. It says Fed launches first round of quantitative easing, or QE1, with plans to buy up to $500 billion in mortgage-backed securities and $100 billion in housing agency debt. And then they went on to do a lot more than just 600 billion, of course. And then Powell went on to more than double the balance sheet in 2020 to 2022. Yes, it was under both presidents, by the way. And now they're trying to wind it back down. But I wanted to reference Ron Rosen, who used to do a lot of good research, and I subscribed to his service years ago. And luckily, Bob Moriarty still keeps a lot of his stuff in an archive on 321gold.com. Mr. Rosen passed away, I think, 3 years ago or so. He was a veteran of the Korean War. Interesting guy. And he loved the markets too, and he loved gold. And the reason I'm looking at this here is because I remember him talking about the running flat correction, and we're going to come to that in a minute, and how important the high from 2011 was to this whole technical formation, Elliott wave formation. And when I was looking at this chart yesterday of the quarterly gold price going back to the late 70s, I realized, we're breaking out. Yes, of course, this is a quarterly chart, so on a monthly, weekly, and daily basis, we could still come back below that line. But I would say what that line is signifying is that it's not just breaking out of that teacup top, but it's definitively breaking out of the high we had in 2011, and you'll see why that's important in a minute when we'll go over Mr. Rosen's research. And it's also, of course, breaking out of the recent highs we had in the last 3.5 years or so, around 2070. So what's this running flat correction all about? And I'm going to reference something you wrote on April 17th, 2021, which was one of his last newsletters, unfortunately. And it's called the Rosen Market Timing Letter, as you can see here. And it's interesting that he goes back in history, which is something I like doing. And he compares April 1942 to December 2008. Why December 2008? Well, because that was just in the aftermath of when Mr. Bernanke announced QE. And you'll see how that's important. So he goes on to talk here about how code breakers helped secure U.S. victory in the Battle of Midway. Advanced intelligence helped the Allies turn the tables on Japan in this crucial World War II Navy battle. It says by April 1942, they had gotten so good at breaking Japan's main operational code, which they dubbed JN25B, that they were able to interpret, decrypt, and translate part of Japan's radio messages within hours of when they were sent. A 5-year bear market in the Dow Jones Industrial Average began in March 1937. This bear market bottomed in April 1942. The Dow Jones Industrial Average knew the USA would win the Battle of Midway before the battle took place. The Japanese code was broken in April 1942, and somehow this knowledge made its way to Wall Street and the New York Stock Exchange. This was immediately reflected by the 5-year bear market in the Dow Industrial Average, bottoming in April of 1942. So we jump forward to December 2008. So this is what Ron Rosen says here. It is important to recognize that the beginning of hyperinflation was signaled with the advent of quantitative easing in December of 2008. Quantitative easing resulted in the running flat correction in gold and silver. Recognizing the running flat correction as the secret signal that hyperinflation is underway is similar to breaking the code that produced victory in the Battle of Midway. And here are the waves. So we've got wave 1 here. That was from September 1999, from $253 to $337, wave 1. Wave 2 was another major bottom. I think it was in 2001 at 256.8. And then wave 3 was the move in gold to just above $1,000 in March of 08, as you can see, a major wave 3. And then you had a wave A, which was when gold dropped below 700 in late, well, I think it was September, October 2008, with the collapse of Lehman, dropped from just above 1,000 to 680 or thereabouts. And he sees that as wave A. And it's also the bottom of when they started quantitative easing, just after the announcement towards the end of November. And normally an ABC correction does not go above wave 3. It stays below wave 3, and then wave 4 catches up and goes above wave 3. But you'll see why this is a running flat correction. So what he's saying here is that we saw a correction of the market going above 1,000 by the market going higher, which doesn't make sense, but just bear with me. So we have wave A. Wave B, according to him, was the high in 2011. And that's why this is so important. So 1923.70, that's what the number he has. And wave C, of course, was December 2015 at 1,045. And that's pretty much when I started this channel. Started making videos for this channel in November. Yeah, and that was the end of wave C, according to him, and then the beginning of wave 4. And that's why 1923 is so important, because to confirm wave 4, we got to go past wave B. And it's interesting that wave C actually held just above the high from 2008, which was wave 3 at 1,033. So we're going to move forward now. And this is what he says about the running flat correction. Somehow, someway gold knew in December 2008, when quantitative easing began. And quantitative easing, of course, for those of you who don't know what it is just basically the Fed creating reserves. And that's what they call bank money, reserves. Out of thin air, out of nothing, not backed by anything. To buy assets, right? Anyway, that the United States of America was going to experience a runaway hyperinflation, a normal correction that began in March 2008 became a running flat correction in December 2008. This running flat correction bottomed in December 2015. This was before President Trump was elected and long before the Democrats took control of the Senate, the House of Representatives, and the presidency. The gold market's code was broken in December 2008. From that time forward, the dollar price of gold has been rising dramatically. The running flat correction has been telling us ever since December 2008. And I quote here, and this is from the Elliott Wave Principles. The forces in the direction of the larger trend are so powerful that the pattern becomes skewed in that direction. So what does that mean? It means that a correction, the bull market is so strong that a correction actually takes the market higher after a top, which seems like, doesn't seem to make sense, but it does when you know what's coming. And that's what Ron Rosen knew. And it's unfortunate that he's not living here to see this evolve, because I think it's going to be quite an amazing thing to see what gold will do, and silver for that matter as well. So that's why that chart I showed you earlier, the current quarterly chart, is so important. And you might be asking, so where's gold going to go? Well, I think you need to think more in terms of where's the dollar or the pound, the euro. And this is not just the dollar that's going to go down versus gold. It's all fiat currencies. I don't know. I mean, I think we will know when it happens, when people don't want dollars anymore for anything, or pounds. And that will, of course, be the currency collapse or hyperinflation. Could we be wrong, Ron Rosen and I? Maybe we could see just a very high inflation, which would still be pretty bad. But as Von Mises said, though, the longer you delay, abolishing the policy of inflation, and it is a policy, it's not like a natural phenomenon. It is the government and the central bank that created. The longer you delay reining it in or stopping it, the bigger the chance that the public will wake up and realize that you're never going to stop it, and that it is policy. And that's when people run away from the currency, and that's when you get hyperinflation, crack up boom, and all the rest. So let's just quickly go through the markets here. It's 8:37 a.m. London time. We've got spot gold at 21.58. Well, the high overnight has been 21.61, so that's an all-time low for the dollar versus gold. If you want to call it an all-time high for gold, you can. And one thing I would say, I personally think we are in territory that it doesn't really matter anymore. I think the biggest risk is having too much fiat currency, too many dollars and too many pounds, euros, whatever currency you have in your country. Yes, it's going to be volatile. Gold could drop below 2100 again, but the die is cast, so to speak. The end is coming. How quick it will be, I don't know. Anyway, silver 24.20. It's up 4 cents. What's the key level for silver, in my opinion? 24.50. I think if we break through there, we could quickly go through to 26, and that's another big resistance, in my opinion. Dow futures is down 67. Nasdaq is down 56. S&P down 10. The currencies are pretty steady except for the dollar. Dollar's down quite a bit versus the yen, down 1% versus the yen, just below 148. What about the other currencies here? Aussie dollar, where's the Aussie? Aussie. It's up 0.5%, just below 66. The dollar's down slightly versus the Canadian dollar, 135.07. And the Kiwi dollar is up 0.5% as well versus the dollar at 61.55. WTI crude is down 0.4%, 78.36. Brent is down just under 0.5% as well at 82.33. Platinum, that's back above 900, is trading at 910, up a couple of bucks. And high-grade copper is approaching 4. It's trading at 389. It's up 0.33%. With that, I'm going to wish you all a very good day. Take care. Bye.